Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to learn about various adjustment of final accounts and its effects. This is the part 1 of the video where we will be taking up few adjustments and we'll check what are its various effects while solving the sum based on final account. So let us see the very first adjustment. Number 1. The very first adjustment is based on closing stock. Now, in each and every sum based on final accounts, closing stock will always have two effects. Number one, the first effect will be on the credit side of your trading account, and second effect will be on the asset side of the balance sheet. For example, in your trading account, it will always be on the buy side, buy closing stock, and in your balance sheet it will always be on the asset side as closing stock. That's your adjustment number one. Second adjustment, the second adjustment is based on outstanding expenses. Now remember, the very first effect of any outstanding expense will be it will get added to the respected expense on the debit side. Now debit side can be either trading or P&L. Second effect of your outstanding expense is that it appears on the liability side of the balance sheet. So for example, if in your trading account you have outstanding wages, then it will look like, two wages add outstanding. And let's say in your P&L account, if you have an expense as salary which is still outstanding, then it will become two salary add outstanding. That's the first effect. The second effect comes on the balance sheet liability side. Only the outstanding values will be written. So it will be, for example, outstanding wages and outstanding salary. So these are the two effects of outstanding expense. Okay, next, adjustment number 3. Now the third adjustment is based on prepaid expenses. Now always remember, the very first effect of prepaid expense will be that it will get deducted from the respective expense and it will come on the debit side of either trading or P&L account. And the second effect, all prepaid expenses, they appear on the asset side of the balance sheet. Now for example, let's say in your trading account, if you have prepaid wages, then it will get deducted from wages. If you have an example of prepaid salary, then it gets deducted from salary. That is in your trading and in your P&L account. The second effect, only the prepaid values will appear on the asset side of the balance sheet. That is adjustment number 3. Next, we have adjustment number 4. Adjustment number 4 is based on income received in advance. Always remember, the very first effect of income received in advance will be that it will get deducted from the respective income on the credit side, usually in the profit and loss account. And the second effect of any prepaid income or pre-received income, it will always be on the liability side of the balance sheet. So for example, if it's an income, okay, in your P&L account on the buy side, so let's say you have a pre-received income of commissions and it will be buy commission less pre-received. And the second effect of this will be the only the pre-received income will appear on the liability side of the balance sheet. That's adjustment number 4. Next, adjustment number 5. Now adjustment number 5 is based on income receivable or income which is yet outstanding. Now the very first effect of income receivable will be that it gets added to your respected income on the credit side of your P&L account. And the second effect, it will be that all the outstanding income, it appears on the outstanding income, it appears on the asset side of the balance sheet. For example, if you have an outstanding income, it would look like, buy commission, add outstanding commission on the income side of your profit and loss account. And the second effect, it will be seen on the asset side, outstanding commission, only the commission value. Okay, now next, adjustment number 6. Adjustment number 6 is based on depreciation. Now, the very first effect of depreciation will be that it will appear on the debit side of P&L account, and second, it will be deducted from the respective asset on the asset side of the balance sheet. So, for example, if there is a depreciation on a fixed asset, on any fixed asset, so it will appear on the P&L account to depreciation on whichever that fixed asset is there. And the second effect will be that on the asset side of the balance sheet, it will be fixed asset minus that particular depreciation. That is adjustment number 6. Next, adjustment number 7 is based on interest on capital. Now, the very first effect of interest on capital is that it will appear on the debit side of profit and loss account. It has to be calculated on the respective capital of of the partners or individually. The second effect is that it gets added to partners capital account, or it goes on the credit side of partners capital account or current account. So in a P&L account, on the debit side, it will be written as to interest on capital of Mr. X, Mr. Y. Okay, and the second effect will be when you note down your capital, it will get added to that. So it will be capital of X plus interest on capital. Again, similarly, capital of Y plus interest on the capital of Mr. Y. This is adjustment number 7. Next, adjustment number 8 is based on interest on drawings. Now, the very first effect of interest on drawing is that it appears on the credit side of your profit and loss account, number 1. And second effect is that it will be deducted from your partner's capital, or it will come on the debit side of partner's capital account or current account. For example, in your P&L account, it will be on the credit side. So it will be written as by interest on drawing of Mr. X or by interest on drawing of Mr. Y. That's the first effect. Second effect, from your capital, it will be deducted. So for example, capital of X less interest on drawing of Mr. X. Similarly, it will be capital of Y less interest on drawing of Mr. Y. One has to note that interest on drawing will always be calculated at half yearly unless otherwise mentioned. So always remember, whenever you're calculating drawings, it will always be half yearly. So whatever is the amount of drawing which you have found, if they haven't given you directly, if they give you a percentage form, always take half yearly. That is adjustment number 8. Next, adjustment number 9 is based on interest on loan. Now, the very first effect of interest on loan is that it comes on the debit side of your profit and loss account. And the second effect is that it will get added to the interest it will get added to the loan on the liability side of the balance sheet. So for example, in a P&L account, it will always be 2 interest on loan on the debit side, and the second effect, it will be loan plus interest on loan on the liability side of the balance sheet. Now the next adjustment is adjustment number 10. Adjustment number 10 is based on interest on investment. The very first effect of interest on investment is that it comes on the credit side of your P&L account, and second effect, it's get added to investment on the asset side. So for example, in a P&L account, it will be on the buy side by interest on investment, only the interest part. And second, on the asset side, that interest will get added to your investment. That's adjustment number 10. Next, adjustment number 11. Adjustment number 11 is based on insured goods damaged or destroyed or stolen and insurance claim admitted. Always remember, whenever there is insurance claim, whenever the goods are lost, destroyed, or stolen, it will have not two effects, but it will have three effects. Number one, the first effect will be that it will appear on the credit side of your trading account the entire amount of goods which have destroyed. Second effect will be on the debit side of your P&L account the actual loss. And third effect will be on the balance sheet asset side the claim. Okay, so trading account it will be on the buy side, by goods damaged or destroyed or stolen the complete amount, the entire amount. On the debit side of your P&L account, it will be to the actual loss by goods damaged, destroyed, or stolen. So, for example, if goods of 10,000 have been destroyed and insurance claim is of 8,000, then the actual loss will only be 2,000. So, 10,000 will come on the trading account, 2,000 will be the actual loss, and the 8,000 which the insurance company is going to give you as claim, it will appear on the asset side of the balance sheet. That's adjustment number 11. Next, we have adjustment number 12. It is based when uninsured goods are damaged, destroyed, or stolen. If insurance claim is not given, then it will only have two effects. Number one, it will be on the credit side of your trading account, and second, it will be on the debit side of your P&L account. In trading, it will be known as by goods damaged or destroyed or stolen, and in P&L debit side, it will be to loss by loss of goods by damage or destroyed or stolen. Only two effects. Next, adjustment number 13. Adjustment number 13 is based on goods distributed as free sample. When goods are given as free sample, it will have two effects. Number one, it will be on the credit side of trading account, first effect, and second, it will appear on the debit side of your P&L account as advertisement. So trading account के buy side में you will write buy good distributed as free sample, and in your P&L debit side you will write it as to advertisement. That's adjustment number 13. Next, adjustment number 14 is based on goods withdrawn by partners for personal use. If any goods are withdrawn by partner for personal use, we use the term as drawings. Two effects. Number one, it will appear on the credit side of trading account. Second, okay, it will be on the debit side of your current or capital account if you're preparing one of them, or it will get deducted from capital on the liability side of the balance sheet. So the first, it will be on the buy side by goods withdrawn, bracket we can write it as drawings, and secondly from capital it will be less drawings. Now capital can be capital of any respected partners. That's adjustment number 14. Next, one last for the day. Next, adjustment number 15 is based on unrecorded purchase of goods. First effect, if it is unrecorded, you have to record it, so it gets added to purchase on the debit side of trading account. Second, you are purchasing always from creditors, so it will get added to creditors on the liability side of the balance sheet. So trading account may it will be to purchase, add unrecorded purchase, and on the liability side it will be creditors plus unrecorded purchase. So these were the first 15 adjustments of final accounts and their various effects. Now there are few more adjustments that we need to note down, but it will be posted in the next video. So if you all have liked this video, please subscribe to the channel and stay tuned for the next video where we'll be completing by taking a few more adjustment, more important adjustment of final account. Thank you.